The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Thank you so much for joining us. We're going to wait just another minute or two here to collect some more attendees as they come in, and we'll welcome you momentarily. So we're at 3 minutes after here, and we will get started. And I see more people coming in, but we're just going to get started. And if you need to, you can come back and see the replay if you missed the beginning. And I am Deb Cartiser. I'm with 12 Points Wealth Management, and our role here and our mission is to educate women in particular about their financial worlds and to help empower them to make better choices and to understand what they need to do to add safety, security, and to live out the mission that they want for their lives. And I'm joined here today by Barbara Mayetta. And Barbara, why don't you go ahead and introduce yourself and talk about what you do here?
Great. I'm Barbara Mayetta. I'm a wealth advisor here at 12 Points. And I work mostly with folks who are approaching retirement or early in their retirement years. And I've become known for helping my clients find more fulfilling, purposeful, and confident retirements, and helping them understand their financial situation and have a plan for moving forward with their lives and enjoying their retirement years. I'm also a mother of 3 wonderful young adults, a dog parent, mother of a dog, and I enjoy helping people with the talents that I have, whether that's in financial planning, wealth management, and it's also with my hobbies like tennis, like rowing, and of course, getting people together to enjoy some relaxing time, drinking wine with their friends.
Great, thanks so much. And I am Deb Cartiser. I am a wealth advisor here as well. And my mission is to lead the 12 Point Center for Women, as I said, empowering women financially and providing education and community in order to help women do that. And I've been in this business for about, well, over 30 years, helping people transfer wealth in an efficient manner and doing it to better themselves, better their communities, and better their families' lives. And I am this sandwich generation member, so 2 kids, one of whom is still in high school, and a 91-year-old mother. So I feel the pain of those of us who are squeezed in between both generations. And I love being outside. Anything outdoor sports related is my thing. Cycling, skiing, hiking, just being outdoors is what I love. So that's who I am, and what we're doing today here is to help women, and women in particular being a little bit different from men in all of this, and so catering what we're doing and how we're educating people to really focus on what makes women different in this. And in terms of investments, women tend to be a little bit more conservative than men. They tend to keep more cash on hand, and that can be a drag for them. It can be something that is dragging down their performance, and they end up with less retirement money because of that sometimes. But unlike men, women tend to buy and hold their securities. So they tend to be very deliberate about how they invest and what they're investing in, and then they hold it. And that really does benefit them. So if you're in and out of the market trying to time things, trying to time when you're investing and when you're selling, it can be a big detriment, mostly because people tend to sell at the bottom and they tend to wait until the market has rallied before they go back into the market. And statistically, interestingly, if you miss the 10 best days of the market over the last 30 years, you've missed half the returns of the market. So half is an enormous amount, all because of timing, and that's missing the 10 best days. And if you miss over the past 30 years, the best 30 days, you've missed 85% of the market return. So women really do benefit by buying and holding, which is great. So what else? How else are we impacted? We have breaks from the workforce. And that means less Social Security payments when the time comes, and typically reduced retirement savings, because if you're not getting an employer match, and if you're not able to sock away money into retirement, you're going to have less when it comes to retirement. But also, women tend to be less confident about managing their family finances. It doesn't mean they're less competent, because they have equal competence, obviously, but they feel less confident. And right now, unfortunately, we all know we're still earning less than men for the same job, so our salaries are lower. We live longer in retirement, so we need to save more than the typical male does. And women tend to, just as we care for others first, we tend to be more generous than men with our children, and that means overgiving financially sometimes. So really, along with caretaking, taking care of yourself first makes a huge impact for women. So please, as we say, put your oxygen mask on first. Taking care of parents and or children financially to your detriment is really a very negative for the family in general. So, and then obviously if you're divorced and your husband or your spouse was the primary breadwinner, you're going to be impacted by that. So Barbara, why don't you walk us through saving for retirement, how we're doing that, and what that looks like?
Sure. So why do we want to save for retirement? Why is it so important? Why every time you talk to a financial professional are they bringing this up? And it's really because retirement is going to be the most expensive goal or event in your life, if you're lucky, right? If you live long enough to make it to retirement and you're healthy in retirement, it's the largest expense by far. And Social Security will not cover the majority of your expenses for most people. And the next page here, we're gonna show you this and why it is so important to not think that you can rely on Social Security. And also, it's really important to be saving, because typically people are going to work, if they work full-time and don't take time off for taking care of their family, typically you're going to work around 45 years. But during that 45 years, you need to save to cover another 25 to 30 years. And that's, as you can see there, a pretty short period of time to cover a long period of time. So why doesn't Social Security, or what does Social Security cover? Social Security determines what your benefit will be by, they calculate something that is, they call it your AIME, and it is that's your average monthly earnings. It is calculated by taking your highest 35 years of earnings, adjusting it for inflation, and then here we go, here's the chart, and then they take that and determine how much they'll pay you. So if your average monthly income is, let's start at the bottom of the chart, below $1,200, they pay you 90% of whatever that first $1,200 is. That's not a lot of money to live off of, $1,200 a month. So for your next chunk, which is between, for the next chunk of money, they will, and I'm sorry, the number that we have on here is actually, didn't come in quite right. It's actually running from $1,200 to $7,000. They give you 32% of that. So you can see that went down pretty quick from 90 to 32%. And then everything you earn above $7,000 up to $14,000, they pay you only 15% of. So you see, Social Security really is already means tested, and they're not paying out very high when you get up to what are more standard of living amounts of money. So you can't rely on Social Security. It helps a little bit, but the more that you earn, the less you're going to get.
So we thought it would be helpful for people to understand what you get from Social Security and a little bit of how it works. It tends to be a little bit of a black box, so understanding it and knowing what you get paid on and what you don't, I think is helpful.
Yep. But it's really important then that women should start beginning saving as early as possible. I'm sure you have all heard about the benefits of compounding, and that's what the graph to the right-hand side is showing us, is that if I begin saving the same amount at 25 or 30, the amount that I will have by the time I reach 67, a normal retirement age, is going to be significantly more. But the other things that it does, starting early, it protects us from something called, sequence of returns for markets. If when I start investing, the returns that the market's making are really high, then I'm going to have more money that's growing over a long period of time, and that's really great. But if when I start investing, the returns are low for the first 5 or 10 years on the market, well, then I have less to be compounding later on. And if I don't start early, if I start late and start at a period of time when the market is not returning a lot of money, then I'm going to be, double impacted here by I started late and I didn't get great market returns. The longer I'm in the market, the more likely I am to be in the market when the returns are coming in well. We also think it's really important to be saving, and the earlier you're doing it, it's important to help you manage your expenses. Because if you get used to spending money and all the money that you're making, it's really hard to start cutting back on your what you spend at a later period in life. So early on, for you now or for your children now, think about you need to be paying to your savings first and then figure out how to live your lifestyle on the remainder. And also, of course, because women may be more likely to take breaks from the workforce, it's important to make sure you're saving for during all of the years that you're in the workforce.
So I think a key component of this is obviously saving early and often, and doing it earlier is better, but also teach your children how to save. Teach your children as you're going along, as they're getting their first jobs, how to put money aside, how to then not touch it instead of just putting it in a different box, a different compartment, but really teach them the benefit of saving and show them what compounding means. So if they can't get much interest in a bank account, pay them interest, pay them to keep it there, but teach them the lesson of savings because it's really, really important.
Deb, we get asked a lot about how much should I be saving? What do you tell your clients?
So really what we want to do is make sure that if you have an employer who's offering you any kind of benefit for saving in your retirement plan, we want you to be putting aside the minimum amount to be able to get that employer's match. It's free money, and everybody should do what they can to participate in the free money giveaway program. So make sure you're meeting that match at a minimum. And really beyond that, what we want to do is see people saving between 10 and 15% of their earnings when they're younger. Now that can be a mix of maxing out your 401k or your retirement contribution and then putting money aside, but really saving that 10 to 15% of your money and keeping it aside. So it's not spending. You're not going to just save it and spend it on a rainy day or for a fun thing. This is long-term savings. And then when mid-career comes along, people are typically earning more. So we want to see people putting aside 15 to 20% of earnings. The old rule was sort of 10%, that works. If I put aside 10%, I'll be fine in retirement. And that was the way it was when we had shorter lifespans. But we're living a lot longer. We're retiring around the same time. And so we have this much longer time horizon in retirement. So that's really important. And then, as your mid to late career, looking at planning to help you determine, do you have enough? People ask us all the time, how much do I need in retirement? Well, that depends on who you are, what you spend, and there's no number for that. So we can't help people arrive at that number en masse, but as individuals, we can certainly help people work on that, and we do. So whether you're working with us, whether you're going online and using a retirement calculator, do something to know, are you on track and are you saving enough?
And this is a time when a lot of people start adjusting their savings rate a little bit once they figure out what do they want to do in retirement and what might that cost. Start that planning, and that's when you do those catch-up contributions to make sure that you're saving for what you want to be doing during your retirement.
So the typical types of retirement accounts are, employer plans. So you're working for a company, they're offering you a 401k, or maybe if you're in a nonprofit, it's a 403b. Similar types of vehicles, just the company that sponsors the plan is different. But these are tax deferred savings accounts. So you're not paying any taxes on the earnings. And with a typical traditional account, your contributions are made before taxes. So you're getting a break on that tax amount. So your income is being drawn down by the amount that you're contributing, and you're paying less taxes on that. Those accounts pay a tax and income tax on the money when you take it out. So if you're looking at what you've saved for retirement, you need to do the tax discount. So let's say you saved $1 million, that's terrific. Now, if you're in the 25% tax bracket and you've got Massachusetts taxes on top of it, you're taking a haircut of 30%. So a different type of account is a Roth account. And so these are after tax contributions. So you don't get any discount on your taxes, on your income taxes when you put the money aside, and you don't get taxed when they come out. So this is after tax money that you're putting into these accounts. And
Deb, all the money that you take out of that account, including the earnings, is tax-free, right?
Right, exactly.
That's very important. All the money comes out tax-free on the Roth.
So 401ks now are offered with a traditional component or a Roth component. So when you're thinking about money to put aside, thinking about where you are, and we'll talk about that in a minute, but where you are, what your tax situation is, and what's going to make the most sense for you based on what you already have. So it's a very personal decision, and we can talk about more about that in a minute. But the other component is for a SEP IRA account. So this is a typically used by a self-employed person. We also have solo 401ks if you're a sole proprietor of your business. But these are ways to put extra money aside, more than you could put aside in an IRA account. And in a solo 401k, you can contribute as the employer and as the employee. So that can be a really compelling way to get money into a tax-free or a tax-deferred account. So we talked before about the traditional and the Roth IRAs, and really they work out the same if all the variables are equal. So if you put money into an IRA at the same rate, tax rate that you're taking it out, there isn't going to be a difference between Roths and IRAs. But the way it works best is if you're at a time in your life when you're a lower earner, so you're maybe fresh out in your career, or you're at the end and maybe you're end of your career and maybe you're earning but at a much lower rate because you're consulting or something. That's a good time to consider a Roth because it's after tax money. You don't have a high tax burden in those situations, so a Roth would make a lot of sense. And then when you're in your highest earnings rate, so midlife typically and late in your career, it's a good time to consider a traditional account, a traditional IRA account, or a 401k, because those are tax that's pre-tax money. So you're getting at your highest earnings rate, you're getting a tax discount on the money that you're putting in there. So really, when you enter retirement, it's really good to have a mix of both types of taxable and tax-free savings. Now, maybe that's not in a Roth because you haven't been setting aside money that way, and that's okay. If you have money that you've set aside in just a normal account, individual account or joint account or revocable trust account or whatever it may be, if that's after tax money that's sitting in there and you've got a mix of taxable and tax-free savings, you're in a good place. So you want to end up with not everything in a taxable IRA account and not everything in a tax-free post-tax account. You want a mixture of both. That's how it makes most sense financially.
We often get asked about, okay, but what should I invest in? Well, the first question we always talk to folks about when we're talking about how to invest is what's the time horizon for when you're going to use this money? When am I going to take it out of the account to buy something with it? And the longer that the time horizon is before you're going to use the money, the more aggressively you can invest because you have time for the market to go up and come back down and recover from a down market. Because once again, the more risk you take, the higher potential there is that there's going to be down times, not just up times when you're taking more risk. So when we think about retirement, lots of people think about, oh, okay, when I start retirement, I'm going to retire in 2035. So that's 10 years from now. So that's when I'm investing for a 10-year time horizon. Well, really, you're not. We mentioned before that you need to be actually planning for spending 25 years in retirement. So you're planning for retirement to begin withdrawals in 10 years, but the last withdrawal is really in 35 years. So some of the money I'm going to be using is at a really long time horizon, and some of it's at a much shorter time horizon. So we need to think about sometimes our portfolios in a couple of different buckets, sometimes we call them, or what is no longer really aggressive or really conservative, being somewhere in the middle, because we're really trying to cover a long time that we're going to be using it. And for some people, like I said, we do multiple buckets. Here's a short to mid-term bucket and a mid to long-term bucket. The more time that you have, the more you can take risk, which in usually cases, people think of going into stocks when they think about risks. Some investment tips that we give.
So I'm just going to stop you for just a second here, Barbara, and talk about just for a minute the fact that as we diversify for our clients, everybody's different. And what we want to make sure is that you haven't put everything in low risk where you're earning nothing and drawing it out right in the beginning of retirement. So being mindful of how your accounts are set up, how the assets are allocated, and then also looking at the difference between taxable accounts and tax-free accounts and balancing those. And that's a time where you can work with your CPA or whomever prepares your taxes to say, how can I best withdraw my money, or your advisor, of course, how can I best withdraw my money without giving myself a tax issue or a tax problem? So balancing also the taxability of those assets, not just how they're allocated as you withdraw them, is important.
One more, yep. So we often get asked about investment tips. Once again, what are the things that we think are really important? Can't give you specific stocks by name because that changes by day, especially these days with the volatility in the market. But some really important things that will be more impactful is, first, diversification. Diversification is really important in people's portfolios. And, when I say diversification, I'm talking about being in stocks and bonds and alternatives. I'm talking about being in large companies and small companies. We're talking about covering many different industries. We're talking about geographically, where am I investing? Lots of different ways to diversify, and really all of these are ways to diversify. I'm going to bring up concentration for a moment in case there are some of you who, work for a company that's sharing with you stock options or restricted stock units, otherwise known as RSUs, or you have other investments in your company or in your company's stock or organization. Because remember, just the fact that you're working there is an investment in that company. And if that company goes downhill, you may lose your job, and the cost of the price that you will receive for any of the stock that you have will go down. So getting too much in one company, even though you work there, can put a big risk on your portfolio if your company starts to run into financial problems. In helping with getting diversification are mutual funds and ETFs. These are two ways of buying groups of stocks or bonds, and actually alternative investments. There are lots of ways of buying groups of these investments in mutual funds or ETFs.
So by the way, an ETF is an exchange traded fund. We should have spelled that out, but that's what that stands for.
Yep. And these funds, mutual funds or ETFs, can be bought. They're really on the mutual fund side, you'll find a lot of them are managed. You're paying a management fee so that people are daily deciding what stocks, bonds should be part of that fund. And some are you buy are index funds, which means they're a set of stocks that are kind of like a basket, and that basket stays the same the whole time. And you're buying into that basket and getting the return from that the stocks in that basket get.
So the attractive thing about this, sorry to interrupt you, Barbara, the attractive thing about this is that it gives people a way to be diversified, away from buying single stocks. So if you can't afford, because your savings isn't large enough, to get the diversification by buying individual securities, then mutual funds and exchange traded funds are a great way to diversify further without having to invest enormous amounts of money to get there.
Yep. And to help you understand your diversification, all of these, both mutual funds and ETFs, you can buy them by kind of groupings of different types. So you can buy industry sectors. So, you know, technology related or utility related, different industries. You can also buy by geography. I can buy international, I can buy US. I can buy large stocks, I can buy small stocks. So there's lots of ways to get different areas of diversification, or sometimes I can buy a mutual fund that's pretty much diversified across a lot of them based on the manager discretion where they think is the best place to be investing right now. You'll often hear people talking about having a 80-20 portfolio or a 60-20 portfolio. These are terms to use. What's the ratio of stocks to bonds? Early in life, an 80-20 portfolio may be appropriate. It's for retirement money that you're not going to actually be using for 40, 60 years from now. So getting more stock exposure, you have plenty of time to watch that market go up and down. But in general, as you see on that right-hand side there, the Dow Jones and the S&P 500, it goes up while taking some downs. Mid-career, 60-40 is a pretty common portfolio mix. And once again, in order to reduce your risk when you're feeling uncomfortable or the time horizon is shorter, you reduce your stock exposure. The one point, and Deb touched on this a little earlier, I really want to emphasize market timing in volatile markets or any time really is very risky. Deb already told you if you're out of the market for the biggest 10 days, what was that number again, Deb?
50%, you miss out on 50% of the returns.
50% of the returns. So if you try to say, oh gosh, I'm hearing the economy is getting bad, the market's going to go down, let me try to get out now. And then I'll buy back in when it looks like it's turned around. Well, a lot of those 10 best days are, by the way, right when that market turns around and people decide, oh, the economy is getting better. And if you happen to be, you know, asleep at the wheel, you didn't get in on that day. So market timing is really difficult and really doesn't pay off. The statistics show it. Stay in the market if this is with long-term money that you don't need to withdraw anytime soon.
Yeah, I think that's really important. We can anecdotally just tell you that I think we can call the bottom of the market when we get 3 of our clients calling in to say, take me to cash. I'm terrified, take me to cash. And it's kind of, we manage that separately, but it's sort of almost a way to have us know exactly where are we in the market, because we don't know either where the market is at any given moment. And we can tell you during the day how it's doing, but we don't try to time the market either. Our investment acumen isn't any better than others. We don't have a crystal ball here. And so when people try to do this, not even the professionals really do this well. So be warned. And I just want to stop and tell people that if we've gotten a couple questions already, which I'll work in at the end, but if you have any questions about anything that we've talked about so far, please put it in the question queue and we can pick that up at the end. And let me just get back here and talk about, you know, other tips for saving for retirement. What other things can you do that can help your retirement situation? One thing is we talked about people and women in particular being out of the workforce. And if you're married and out of the workforce, you can contribute to a spousal IRA. So even though you're not working, you can put money aside in an IRA account. You can't put the larger amounts aside in 401ks. You can in 401ks and things like that, but at least it's something that if you have a working spouse, you can make use of. And the
Yeah, and just so you know, a spousal IRA is not a specific type of account. We were referring to it as a spousal IRA, but it is when you go to invest in one of these, it's not called a spousal IRA. It's just a regular IRA, but the government allows you to make the contribution.
Yeah, that's a good point, because people will probably go and ask to open one, and there's no such thing in terms of titling. So thank you for that. Yeah. The other thing is, if it makes sense for you, and let me say that again, if it makes sense for you to have a high deductible health insurance plan for you and or your family, you can make use of a health savings account. Now, we don't want anyone to go and pick a high deductible plan just to get the health savings account, but if it made sense and you have one selected, you can participate in this. And even if your company doesn't offer a company sponsored plan, you can go to the Fidelities and the Schwabs and the Vanguards of the world and open one yourself. The qualification is having that high deductible health insurance plan, and you can Google the limits on what that is. But if you have such a plan and you're not using your expenses for that year, save it, keep it there. It's growing tax-free, and what you can do is spend that money in retirement if it makes it that far. So on years where you don't have much to spend in terms of healthcare, putting it in that health savings account, keeping it there and letting it grow tax-free. It's not an enormous amount that you can put aside, but it can be helpful. And you can use it and let it grow for years and decades. And then what you can do is to maintain your receipts that you've spent earlier in life for things that you can afford the cost of. Let's say you've paid deductibles, you've paid other healthcare costs. Scan those receipts, keep them in your computer, and years later you can go and take distributions and pay yourself on the expenses that you had from years earlier. So that's important to know. And then for those who have saved for college and put it in a 529 account, you can take those excess dollars in that account that your child's not using because they've graduated or done what they need to do with their education plan, and you can convert that into a Roth IRA up to $35,000. Now, this is very new legislation, and they haven't quite worked out all the kinks or questions yet, so we don't know what you can do about changing the beneficiary. In other words, could you give $35,000, put that in a Roth for a child, and then change the beneficiary and do that for yourself? How often? Can you do it multiple times a year? Those things haven't been ironed out yet. So stay tuned on that to see if there's more that you can do with your 529s where you have money in them. And then our other tip is for business owners. For those of you who are running a business, large or small, plan for and start thinking about your business in retirement. What does that look like? Are you still running it? Do you need to have somebody buy it from you? How does that look, and how are you going to, so not only are you managing your household finances for retirement, but also your business, and making sure that there's a plan for that and that you're planning earlier than you plan to retire, because maximizing the value of the business that you've built and created is really huge. So making sure that people are thinking about that and working on that well in advance. And that's another piece that we take care of here at 12 Points. We have a business advisory service that does just that. It's helping people to coaching them and helping them work with getting their business ready for sale, and then helping them go through the sales process with that. So if that's something that you need and is beneficial to you, contact us about that. So these are all the fun legal disclosures that we have. And what I wanted to highlight is that we're doing these webinars every month. And our next one is going to be on May 2nd. And I think I'm stealing your thunder on that, Barbara, but we are going to be talking about helping women find their passion, and what does that look like? How do you get there? And what's some of the thought process and the exercises you can do to help yourself there? And in addition to that, we've also got a workshop series that we're doing here in the office, and Barbara is heading this series up as our retirement person, and she is putting together a workshop And tell me what, actually, you take it away, Barbara. Talk about the workshop.
Sure. So we've been covering many topics on how to elevate your lifestyle in retirement. But we do have a workshop coming up that's focusing on if you're closer to retirement and thinking about, well, how do I transition now from this saving for retirement that we just spoke about today to what should I be thinking about as I'm getting really close to retirement and wrapping up the saving, and what do I need to do so that I can start taking withdrawals and safely control my Medicare costs, my tax rates. How do I invest differently now that I'm in a withdrawal situation? Lots of things to consider that we're going to be running. Probably we'll even maybe have one of these workshops for you guys too as the women, but we are bringing together groups to talk about how to transition your finances to your retirement. So, and for those of you attending, we'll send you invitations. Or contact me also if you're interested in learning more about this.
Exactly. So Barbara's email here, if you're not on our mailing list and you haven't received anything to this point, please email barbara@12points.com to ask to be added to the list, and we would be glad to include you on that. And let me just grab a couple of the questions here, Barbara. I have two of them. Talk about Social Security, and are we concerned about there being cuts, substantial cuts there? What can people expect?
Well, I think, we do not know. We don't have that magic ball that's going to tell us exactly what's happening. However, we do know that there are, millions of Americans dependent upon Social Security, and most of the workforce is not, and most of government is really in support of continuing to pay out because Americans need to be taken care of. So we're not anticipating big cuts in Social Security. It might be anticipating a little bit that the way we go about applying for our Social Security is changing, and I think we've all heard that. And potentially how it is taxed may be changed, but maybe for the lower. So in other words, a lot of changes. We'll probably see some tweaks. We may see some increases in the Social Security, what we're paying taxes on our income, on the payroll taxes that we pay that help fund it. But in general, we're viewing that Social Security continues. Some of our clients who are nervous about this, when we do our financial planning with them, we discount what that payout might be to help them understand what would be the impact if the rates of Social Security are reduced. So we're working with people to plan in multiple scenarios.
Yeah, and I think when we do our retirement forecasting, we always include it, and we include it at the current levels. So when we're showing how people's assets project out into the future, unless someone asks for it, we don't remove the Social Security component, because it's an asset that we have and we consider it something that's going to continue. The other question is, I'm looking for advice. I'm one of 3 kids, adult kids, I'm guessing, who are I'm considering taking care of my parents. I'm guessing they're the closest geographically. Do you have any advice? And I think for this question, and this is a great question because as we've talked about, and as we say often, women are so much more often than men, so often the family caretaker, particularly the oldest female daughter. Females are our daughters, but there we go. So the advice that we give you on that is talk within the family, and while this burden of care is falling on you, is there a way to treat this as a salaried position? And if your parents can't afford to pay for it, perhaps your siblings can. And, often within a family, the other siblings are wishing they could do more, wishing they could help. And if the situation is right, if you can get some part-time income for that role from the family, either your parents or your siblings, that would be a great way to do that. You can add to retirement savings that way, and you can be paid for what you're worth, which is something we all need to focus on. Barbara, do you have any other ideas or suggestions on that one?
No, I think that you covered it well. I see that one other question about out there about my husband is 5 years older than me. Are there pros and cons for retiring together versus when we each reach a certain age, say 70? And one of the things I want to mention, because when I see the age 70, I think, well, are people thinking retirement, or are they thinking when I apply for Social Security? And by the way, you can apply for Social Security before you retire. You can also apply for Social Security well after you retire at, say, age 70. I think for couples, I really work on what is it that each couple wants in retirement? How do they want to spend their time? And is it important that they're together and that they have time to spend together? And really looking at the finances of what do we want to do? And if we want to do this together, then do both of us need to work till, let's say, 68, or he to 68 and me to 63? What is it together that at what point do we as a couple have the money to achieve our goals? And it may be that the goals are not all goals you want to do together. So it's okay for one to retire earlier and start working on their goals that are important to them, and then both retire together and do the traveling together at that point. So I view it as what's important to the couple, what they want to do together and what they want to achieve separately, getting to the discussion on passion. How do each one of them find their passion and their purpose? And which ones of these are joint and which ones of these are separate? As to how you want to spend your time, does it need to be both together or both apart? A lot of couples do find that, wow, we've gone from 40 to 50 hours a week working separately to, wow, I retire and we're in the same house. Do we have to spend all of this time together and do everything together? So it's important to find what your passions are and where do they overlap with your husband? What time are you going to be spending together in the future and what not? So can't say that there's a right or wrong. Certainly looking at Social Security, it's really kind of good to look at whoever the highest earner is, at least, is holding off to age 70 if you can, because that maximizes the payout, not just for that person over the remainder of their lifetime, but it maximizes that payment for whoever lives the longest. So making sure that the biggest payment is achieved between the two of you. Really important goal if you can do that. Not everybody can swing that if they're investing or if they're retiring many years before 70.
Yeah, so I think that's a really, your answer included a lot of things. Your answer included, it depends on what's best for them financially, first and foremost, from our perspective. And then what are your goals as a couple and what are you trying to do? And then your piece about Social Security and waiting to age 70 to get that, you earn 8% per year for every year you delay Social Security. So if you're a healthy person with a healthy and longevity in the family and you're not expecting to expire in those first few years, if you can hold off to age 70 and your plan permits that, it's a great thing to be able to do. So there's been a lot online lately saying, oh no, take the money, but it's not always the best solution. So thank you for that. Well, that's the end of our questions, and we thank you very much for joining us here today. And I just want to make sure that you contact either Barbara or me if you're looking for more information on any of the topics we talked about today, or to be added to our mailing list to hear about our webinars. And these are on replay. They'll be on replay on our website. So thanks very much for joining us, and we wish you a happy weekend.